Today we will cover Chapter 9, Analysis of Financial Statements. Um, Today's agenda is I will give the finance diamond figure and explain the analysis of financial statements, where we can put the analysis in this figure, the firm's disclosure of financial information, and we will cover the balance sheet, income statement, other key financial ratios, statement of stockholders and equity, statement of cash flows, depot analysis, limitation of accounting data, and wrap up. So if you look at the figure, you will see we have savers, financial institutions, borrowers, and financial markets. We already covered the present value and the future value formulations, the perpetuity, annuity formulas, return formulas, and risk measurements. And now we will cover the financial statements. The financial statements produced by firms and government institutions, and we will cover the financial statements in this chapter. Financial statements are accounting reports issued periodically to present past performance and a snapshot of firms, the assets, and the financing of those assets. Investors, financial analysts, managers, and the other interested parties such as creditors rely on financial statements to obtain reliable information about corporation. So they produce quarterly and annually the financial statements, and public companies must file financial results with the Securities Exchange Commission. On a quarterly basis, they have 10Q, and for annual basis, they report called 10K. The annual report with the financial statements must be sent to shareholders every year. Financial statements must be reliable, understandable, and comparable. Generally accepted accounting principles is set by the Financial Accounting Standards Board to provide common sets of rules and a standard format for public companies reports. Corporations are required to hire an auditor to check the annual financial statements to ensure they are prepared accounting according to generally accepted accounting principles, provide evidence that information is reliable. So each 10Q and 10K filings should be audited by auditors. You may heard the company KPMG or other independent auditor companies. They audit the filings of the public firms on behalf of the firm, and they ensure that they are prepared according to the generally accepted accounting principles, and they provide evidence that the information is reliable in those filings. So the four financial statements required by the SEC is the balance sheet. The balance sheet is the financial statement that enumerates as of point in time what an economic unit owns and its net worth. So what have the one method of answering so what have the owners invested in a firm? So one method of answering this question is to construct balance sheet that enumerates what a business owns, that is assets, and what is owes, that is its liabilities, and to calculate the difference. The difference is called that the net worth of stockholders' equity. So the first statement is balance sheet. The second one is income statement. The third statement, financial statement, is cash flows, statement of cash flows, and the fourth one is the statement of stockholders' equity. Balance sheet, as I explained before, the balance sheet enumerates what a firm owns, assets or owes liabilities, and its net worth, equity. So assets minus liability equals equity. And assets or items or properties owned by the economic unit. Liabilities is what an economic unit owns, and stockholders' equity is what firm's net worth, the difference in firm's assets and liability. So assets equals liabilities plus equity. The two sides of the balance sheet must be balanced. We have assets, we have liabilities, and equity here. And the total amount of assets should be equal, the total amount of liabilities and equities should be equal. Balance sheet, as you see, this is the balance sheet of a global corporation. Assets for 2010 and 2019, liabilities and stockholders' equity. This here until here is liabilities, and the stockholders' equity is here for 2 years, 2010 and 2009. As you see, total assets is equal the total liabilities and stockholders' equity as of 2019. It's similar for 2010. For 2009, the total assets should be equal total liabilities and stockholders' equity for 2009. What is current assets? Current assets that are relatively liquid or expected to be converted into cash within 12 months, and current assets typically include cash, account receivables, inventory, and other assets. Long-term assets, the assets that produce benefits for more than 1 year, and include long-term assets value reduced through a year. Yeah, long-term assets value reduced through a yearly reduction called depreciation. For example, there is a asset can be warehouse, it can be equipment, and the value, the asset value depreciated year by year. Also, long-term assets includes fixed assets, the machinery, equipment, buildings, and land. And other assets includes these assets. They are neither current assets nor fixed assets. They may include intangible assets such as patents, copyrights, and goodwill. So current liabilities is debt and liabilities that should be paid in less than 1 year. For example, account payables, accrued expenses, short-term notes. Long-term liabilities include debts and liabilities that should be paid in more than 1 year. For example, we can give, for example, for the long-term liabilities is we can give the example of loans from banks for longer than 12 months and bonds. Balance sheet, equity, shareholders' investment in the firm in form of preferred stock and common stock. Treasury stock, the stock that was once outstanding and has been repurchased by the company. And retained earnings, cumulative total of all the net income over the life of the firm, less common stock dividends that have been paid out over the years. Okay, so let's look at the balance sheet again. As you see, we have assets include current assets, fixed assets, other assets, and we have total assets here. And we have liabilities, current liabilities, long-term liabilities, and total liabilities. We have owner's equity, including preferred stock, common stock, and retained earnings. And we have total owner's equity, and we have total liabilities plus total plus equity. That should be equal to total assets. So what is the book value of equity? This is the net worth from an accounting perspective. So book value of equity is assets minus liabilities. So book value per share is book value of equity divided over number of shares outstanding. Market capitalization is market price per share times number of shares. It does not depend on historical cost of assets. This is just the market value of equity equals the price per share multiplied by number of shares outstanding. Market to book ratio is market value of equity over book value of equity. Net working capital is the capital available in the short term to run the business, which is equals to net working capital equals the current assets minus current liabilities. Liquidity ratio is, it measures the firm's ability to pay its bills on time. The current ratio is current assets over current liabilities, and quick ratio is current assets minus inventory over current liabilities. Debt ratio, in other words, leverage ratio, is the debt over net worth ratio, which equals the total debt over total equity. The debt ratio is total debt over total equity. So we mainly use this debt ratio, which is total debt over total assets. Enterprise value is market value of equity plus debt minus cash. Okay, let's solve the problem. Problem 1. So market versus book value refer to global balance sheet in 2010. If global has 3.6 million shares outstanding and the shares are trading at the price of 10, what is the global's market capitalization? We just multiply shares outstanding, number of shares outstanding, multiply by 10. How does the market capitalization compare the global's book value of equity? We should look at the global's book value of equity and compare the value that we find from the previous section. And what is the global market to book ratio? Just market value divided by book value is the market to book value. Okay, solution for the first section. As you remember, we have 3.6 million of shares multiplied by the share price. This is the market value of the market capitalization. This is the market capitalization. Yeah, and the second one, we should look at the global's book value of equity. Let me find, yeah, so global's book value of equity in 2010. Let's go back, 2010, book value of equity. Book value of equity is, as you see, in 2010, 22.2. Let's go. Yes, book value is 22.2 and market capitalization is 36 million, and market capitalization is significantly higher than the book value of equity. Okay, and C, the global must have sources of value to do do not appear on our balance sheet. This may include, so why we have higher value here. The market value is 36 million, but the book value of equity is 22.2 million. What is the difference? Almost $14 million come from? It can come from the opportunities for growth, or the quality of the management team, the relationship with suppliers and customers. So this is just the value of the company, which is not reflected in the balance sheet. How can we calculate the market-to-book ratio? It's easy. Market value divided by book value. Market value is 36 million, and the book value is 22.2, which is 1.62. Second problem, looking at the global balance sheet. If global has 57 million as total current asset and 24.7 million as total current liabilities in 2010, what is the global's net working capital? As you may remember, the net working capital is the difference between current assets and current liabilities. As we know, the current assets, which is 57, and the current liabilities is 34.7. The difference is 22.3 is the net working capital. Problem 3, according to global financial information in 2010, you will only look at 2010. What is the company's quick ratio? And what is debt ratio? Okay, the quick ratio is current assets minus inventory over current liabilities. So current assets, as you see, current assets 57 minus current liabilities, current assets minus inventory 15.3 divided by current liabilities, which is here, current liabilities. So for the quick ratio, we are using total current assets 57 minus inventories 15.3 divided by current liabilities 34.7. This is quick ratio. You see, current assets 57 minus 15.3 inventory divided by current liabilities 1.20. How can we calculate a debt ratio? We look at the total debt over total assets. How can we find total debt? When you go 2010, the total debt is total liabilities 147.9 divided by total assets, which is 170.1. So that ratio is, we'll need to look at the total liabilities here, 147.9, or total assets for 2010 is 170.1, which is 80%, 86%. Income statement. The income statement shows the revenues and expenses of the firm over a period of time. So I would like to emphasize that the balance sheet is just snapshot as of let's say December 31st, 2010. This is just a snapshot of the assets and liabilities of the company, but income statement is over a period of time, shows the revenues and expenses over a period of time. So it shows a firm's accounting profits and losses. It's not a summary of a firm's cash receipts and disbursements. The last or bottom line of the income statement shows the net income over the period. So you should find net income, sales, minus all expenses. Let's look at um, the income statement. As of 2010, net sales are 186.7, cost of sales 157.4, and we have, when we subtract from cost of sales, when we subtract the cost of sales from net sales, we get gross profit. When we subtract selling, general and administrative expenses, research and development, and depreciation of amortization from gross profit, we will get operating income. When we subtract, when we include other income, we will get earnings before interest and taxes. When we subtract interest income from EBIT, earnings before interest and taxes, we will get pre-tax income. When we subtract taxes from pre-tax income, we will get net income. And by using net income, we can find earnings per share and diluted earnings per share. Okay, the revenue is the money obtained from the selling the company's products or services. And the cost of goods sold is the cost producing and acquiring the goods or services to be sold. Operating expenses are the expenses related to marketing and distributing the product or services and administrating the business. Financing cost is the interest paid to the creditors, and dividends paid to preferred stockholders. Tax expense, amount of taxes owed based on taxable income. Depreciation is the allocation of the cost of fixed assets using a plant or equipment over a period of time. So you have a warehouse. The lifetime of the warehouse is 30 years. The cost of the warehouse is let's say $30 million. So you need to decide, you need to find redefine or revalue the value of the warehouse each year by looking at the lifespan of the warehouse and at the beginning, at the value of the warehouse at the beginning of the period. So it's important because it's a non-cash expense which affects the firm's taxable income, which reduces its taxes. Since depreciation is a non-cash expense, it's added back to earnings to determine the firm's cash flow from operations. So we have different methods. First one is straight line depreciation, and second one is accelerated depreciation. What does it mean? Straight line depreciation is allocating cost of an equipment by equal amounts over a period of time. Same example. So you depreciate 1 million. So 30 million cost for the warehouse and the 30-year lifespan. So every year it depreciated 1 million, and we need to allocate this depreciation year by year, giving a 1 million. Another method, accelerated depreciation, allocating cost of equipment by a larger amount during the earlier years of the asset's life. For example, first year depreciating, so the value of the warehouse is 30 million. You depreciate 5 million in the first year, 4 million second year, 3 million third year, 2 million fourth year, 1 million fifth year, and so on and so forth. So straight line, the depreciation is annual depreciation is equal to cost divided by anticipated useful years. So in the income statement, you will see the sales, you will see operating expenses, and income before depreciation, the difference between 800 and the 500, 300, and depreciation is 100, and taxable income is 200 because you subtract depreciation from the income before depreciation, and you will pay, let's say, $50 taxes, and your net income is 150. So, example, a machine is bought for 400, and the firm anticipates the machine will have a useful life for 4 years. 4 years. Then the firm depreciates the machine on a straight line basis for 100 a year. So the cost is 400, the lifespan is 4 years, so annual depreciation is 100. So depreciation affects the taxable income, thus change the tax a firm will pay. As you see, depreciation can affect the tax that the company will pay. So for the first year, the depreciation expense is 100, second year 100, third year 100, and 4 years 100. So the depreciation rate is 25%, because well, how can we find depreciation rate? First year 100, and the value is 400, you will have 25%. Similar for second year, and third year, and fourth year. Another depreciation method is the accelerated depreciation. A greater proportion of the asset's purchase price is depreciated in early years of the asset's life, and depreciation charges are larger when the equipment is relatively new and smaller when the equipment is old. Plant equipment are generally depreciated under the modified accelerated cost recovery system. So let's look at the probability ratios. What is gross profit margin? It shows how much a company earns from each dollar of sales after paying for the items sold. How can we calculate? Gross profit margin is, in the numerator we have sales and cost of goods sold over sales. So this is gross profit margin. Operating profit margin shows how much a company earns before interest and taxes from each dollars of sales. In the numerator we have EBIT, earnings before income and tax, over sales. This is operating profit margin. And net profit margin is the fraction of each dollar in revenue that is available to equity holders after the firm pays interest and taxes. So net income over sales is net profit margin. Return on equity, it measures how much money firm made for $1 of equity. So return on equity is, this is your return, net income over equity, which is return on equity. Return on equity. Return on assets, same. Return on assets is net income over total assets. It measures how much money from a firm made for $1 of assets. Operating return on assets indicates level of operating profits relative to the firm's total assets. So operating return on asset is, operating return is earnings before interest tax over total assets, which is operating return on assets. You will have these formulas and definitions in your I will give the table. I prepared a table that you can just you don't need to memorize all the ratios, but try to understand what does it mean. Activity ratios is, in other words, turnover ratios. Account receivable turnover, which shows the speed with which account receivables are collected. So account receivable turnover is sales over account receivable. So it is sales over account receivable, meaning if the sales are 100 and account receivable is 100, the turnover, account receivable turnover is 1 in for the period of income, for the period of um, 1 year, if you are looking at the 10K filings. So how can we calculate account receivable days? The turnover is, account receivable turnover is 1, and account receivable days is 365. Inventory turnover is, it shows which inventory is sold. Excuse me. Inventory turnover is the speed with which inventory is sold, and we can calculate sales over average inventory, current year and prior year. Average inventory is current year inventory plus prior year inventory divided by 2, average inventory, and we can find inventory turnover by having average turnover. So let's say the company sales is 100K and average turnover is 50,000. So the inventory turnover is 2. How can we find inventory turnover days? We just use inventory turnover here, and we divide 365 over inventory turnover, which is inventory turnover days. Total assets turnover, how efficiently a firm is using its assets in generating sales. Total asset turnover is sales over total assets. So if the total asset is 100,000 and sales are 50, you will get 50% turnover. The higher the higher the ratio, the better the firm is, because from a limited for some amount of total assets, it can produce or generates more sales. So think about this way, that if you have very minimum assets but your sales are very high, it means the company is more efficient. It is the same for same logic can be applied for the reverse, meaning you sell nothing, sales are 0, but you have 100,000 assets. You have assets but no sales, so the company is not efficient. So these ratios show the efficiency of the firm. Fixed asset turnover examines the efficiency in generating sales from investments in fixed assets. Same, fixed assets in the denominator and the numerator is sales. You will find the efficiency. Fixed assets turnover. You will find the fixed asset turnover by dividing sales over fixed assets. So fixed assets are underlined in total property, plant, and equipment. Let's look at market ratio, the price to earnings ratio. We also call it PE ratio. It measures how much investors are willing to pay for $1 or reported earnings. Let's look at the calculation. The price to earnings ratio is price per share and earnings per share over earnings per share. coverage ratio times interest earned. In other words, interest coverage ratio. It measures the firm's ability to meet its interest obligations using its operating income. Let's look at the calculation. Times interest earned is earnings before interest over interest expense. We will use interest coverage ratio definition for the calculation. Okay, let's look at problem 4. Given global corporations, the financial statements below compute the following ratio at the given at the year end of 2010. We have a bunch of ratios from 1 to 10, 1 to 11. Let's calculate these ratios. Okay, we have the balance sheet and income statement, and let's calculate the gross profit margin. Gross profit margin is sales minus cost of goods sold over sales. Where can we find the sales figure? It's in the income statement, and you need to look at the net sales, which is 186.7 minus cost of goods sold, which is 157.4. Over sales 186.7. The gross profit margin is 17.84. Let's look at operating profit margin. We need to find earnings before income tax over sales. Where can we find earnings before interest and taxes? It's in the income statement. When you look at the income statement, you will see the earnings before interest, and we already know the net sales 186. We find the operating profit margin is 5.57. Net profit margin. Net income over sales. Where can we find net income? Net income is the income statement, and look at the income statement. You will find the net income for 2010, which is 2 over sales. The sales is 186.7. You will get net profit income is 1.07%. Return on equity. Net income. You remember net income, which is 2 millions over equity. Where can we find equity? Equity is in the balance sheet, and you need to go to the balance sheet to find equity, total stockholders equity for 2010, which is 22.2. You will write 22.2 in the denominator, and the numerator is net income, and you will get 9% for the return on equity. Let's clean here. Okay. Okay. Where we are, return on assets. Return on assets, net income is in the in the income statement, which is 2, and total assets you will find for 2010 from the balance sheet 170.1. The return on asset is 1.176%. Operating return on assets is EBIT over total assets. EBIT is income statement. You will find EBIT here, earnings before income tax, for 2010, not 2009. Okay, so for 2010, earnings before income tax is 10.4. Over total assets is 170.1. You will get 6%. Account receivable turnover is equal to sales over account receivables. Sales, where can we find sales? Of course, income statement. You will go to the net sales, which is 186.7. Account receivables, where can we find account receivables? Account receivables in the balance sheet. You need to go balance sheet and find account receivable for 2010, which is 18.5. So account receivable turnover ratio is 10.092. Inventory turnover is sales over average inventory. Where can we find sales? Sales is the income statement. Here, 186.7. Average inventory, you need to go to balance sheet and look at the assets part and find the inventory. But we need average inventory, which is inventory for 2010. Inventory for 2010 is 15.3, and for 2009, 14.3. You need to find the average of the inventory. Take those numbers, 15.3 plus 14.3 divided by 2, find the average. And inventory turnover is sales over inventory, average inventory, which is 12.615. Total assets turnover, sales over total assets, sales in the income statement, and total assets in the balance sheet. As you see, total assets is 170.1 and sales is 186.7, and the total asset turnover is 1.09. Fixed asset turnover, sales over fixed assets. Okay, so we know the sales from income statement. Here 186.7, and the fixed assets is in the balance sheet, and we can find fixed assets in the balance sheet looking at the, what should we look at? Net income, net property plant and equipment, 13.1. So the fixed asset turnover is 1.65. Interest covered ratio is a bit over interest expense. Where can we find a bit? It's in the income statement. You will go to the earnings before interest and taxes for 2010, which is 10.4, and we will find interest expense, which is in the it's in the income statement. Interest expense here, interest expense 7.7, and interest coverage ratio is 1.35. Okay, let's solve problem 5. According to the income statement of a global corporation, it has a net income of 2 million at the fiscal year end of 2010. The company has 3.6 million shares outstanding and its stock price is $10 per share. What is Global's PE ratio? PE ratio is price earnings ratio, and we need to find price per share and earnings per share, and we use the price per share over earnings per share. How can we find earnings per share? Earnings per share is net income over total number of outstanding shares. So we have net income is 2 million divided by total number of shares, which is 3.6. What is earnings per share? It is 0.556. This is just the one part of the question. Now we find earnings per share. What is price per share? Price already given to us, which is 10. So price per share is $10, and earnings per share is 0.556, and earnings per share, the price earnings ratio is 18. Statement of stockholders' equity. Break down stockholders' equity computed on balance sheet into the amount came from issuing new shares and retained earnings. So change in stockholders' equity is equal to retained earnings plus net sales of stock. And yeah, and which is equals to net income minus dividend plus sales of stock minus repurchase of stocks. So this is retained earnings. Retained earnings is net income minus dividend is retained earnings, and net sales of stock is sales of stock minus repurchase of stock. The two part of two of them is equal to change in stockholders' equity. So return earnings is net income minus dividend, and payout ratio is dividend paid over net income. Statement of cash flows. Cash flow statement serves as an important supplement to income statement for investors. Cash flow statements is the financial statement summarizing cash flows and cash outflows. Uses the information from the income statement and the balance sheet to determine how much cash the firm has generated, how that cash has been allocated during a set of period. So it's divided into three sections: operating activities, investment activities, and financing activities. When we look at the cash flows, in each section it enumerates the inflow and outflow of cash. The cash inflows are a decrease in an asset, an increase in liability, an increase in equity, and the cash outflows are an increase in an asset, a decrease in liability, and a decrease in equity. Okay, DuPont analysis. It expresses the return on equity as a product of profit margin, asset turnover, and the measure of leverage. So return on equity is equal to net income per dollar of sales times sales per dollar of assets, and multiply times assets per dollar of equity. What does it mean? So we can find return on equity by using three multiplications, which are net profit margin, net profit margin, asset turnover, and equity multiplier. So when you multiply these three components of return on equity, you will find sales, total assets gone, and you will only have net income over total equity, which is return on equity, right? When you multiply these three components, sales should be gone, total assets gone, and you will only have net income in the numerator and total equity in the denominator, and which is basically gives us the return on equity. So let's solve a problem. Problem 6. The following table contains information about Walmart and Nordstrom. Compute their respective return on equities and then determine how much Walmart will need to increase its profit margin in order to match Nordstrom return on equity. So we have profit margin, asset turnover, equity multiplier for each company. Let's solve. So return on equity for Walmart, we just multiply 3.6, 2.4, and 2.6, and we have 22.5%. For the Nordstrom company, we multiply 7.7, 1.7, and 2.4, and we find return on equity for Nordstrom company, and which is 31.4. So the second section of the question asks us compute their respective return equities and then determine how much Walmart will need to increase profit margin, in order to match the Nordstrom return on equity. It's easy. As we know, the Nordstrom return on equity is 31.4, and we already have the asset turnover and equity multiplier for the Walmart. We're trying to find what should be the profit margin for Walmart in order to have equal return on equity as Nordstrom has. So we are using 2.4 for Walmart and 2.6 for Walmart as an equity multiplier, and we try to find profit margin. So as we know, return equity is 31.4. 31.4 is equal the profit margin Walmart multiply by 2.4 multiply by 2.6. So multiply two numbers and we divide to 31.4 over 2 multiplication, which is 6.24. So we find 5% gross margin for Walmart. Okay, what is the limitations of accounting data? Accounting data do not take into account non-measurable items such as quality of the research department or the marketing performance of the firm or the quality of management team or the board of members, CEO, and the publicly available accounting data are only aggregate data, and accounting data may be biased, and accounting data provided by management may not be sufficiently challenged by auditors. So wrap up, we learned the importance of financial statements, 3 financial statements, ratio analysis, report analysis, and you don't have homework free. So please read your notes, PowerPoint slides, chapter 8 and 9, and you will have a quiz on Blackboard, which only includes chapter 8 and chapter 9 at 2 p.m. So before having your exam, quiz 3, please go MindTab and do the exercises, solve the quizzes, and they have, the MindTab has video reviews, and they also have PowerPoint slides and flashcards. Look them and solve all the questions. So all the questions will come from the MindTab exercises and quizzes. That's all for today. Thank you for your attention. See you next time.